Hey everyone, Brian Shannon here from alphatrends.net. Today's Friday, the 12th of September, 2014. Let's take a look at the closing numbers here for the week. The S&P 500 lost about 1%, as did the Russell 2000. Only about 0.5% for the NASDAQ, which did obviously hold up better. The semiconductors broke some important support that we'll talk about in just a moment here. And the biggest hit really was the commercial real estate, which was down close to 5%. That probably had a lot to do, of course, with the fact that bonds sold off and yields went higher. Gold had a tough week as well, so let's take a look objectively at the trends. The S&P 500 is flirting with the prior high back here from July, and it's been holding up on a closing basis near that 20-day moving average, closed below it today. When we look at a 30-minute time frame, we do see that the market looks like it's starting to roll over here. So we had the pattern of higher highs and higher lows above a rising 5-day moving average. The market then turned sideways as the 5-day moving average flattened out, and now we've got lower highs and lower lows below a declining 5-day moving average. So despite the fact that the longer term uptrend is still very much alive here, on the 30-minute time frame, the intermediate term time frame, which is the primary trend that I like to look at, we are now in a downtrend, and we have to look at this market as less likely to provide us with good upside opportunities. Now, that doesn't mean there won't be opportunities to trade on the long side. It means that the average stock, especially on a day like today where we had 2,500 advancers and 600 decliners, the average stock will have a more difficult time moving higher. So new purchases should be put aside basically for a bit, except for in the individual stocks that are showing us where there are low risk, high probability trades to the long side. You can't trade every single stock based on what the S&P 500 is doing. That just doesn't make any sense. Have to trade each stock on its own merit. So if we're looking to get back long the S&P 500, I think next week at about $200.50, this is going to be the little band of resistance that we want to see taken out. So $200.25 to $200.50. If we can get back above there and hold above there, that 5-day moving average will be flattened out, and this market can turn higher. Now, we've got a big IPO next week. We've got the Fed next week. So we've got a lot of things coming up that act as potential catalysts. But for now, if you're not comfortable being short, which I don't think you should be aggressively short, then cash is generally a good position when it comes to the S&P 500. Now, for the NASDAQ, we are still kind of in this sideways movement, and we have the bigger level of support, 99 to 99 and a quarter. So until we break below that, we are below that 5-day moving average, and it is turning lower slightly. That's not a sell signal or a short signal, but if we break support and then hold below that 99 level, then it looks like we could have the potential for a bigger pullback, maybe all the way back down to the prior July highs in this market as well. Or we could take a look at Fibonacci and say, based off of this most recent rally that we've experienced, the lows from August to the recent highs, a 38.2% retracement gets us down to about $98 a share, and you can see that's pretty close to this area as well. So that's a potential level that, if the market breaks and holds below 99, to be aware of. Otherwise, it's just kind of chopping sideways in here, back and forth, and there's good opportunities in the individual stocks, although some of them seem to be maybe getting a little bit tired. The Russell 2000, we did see a break of that 115 level this week. It held it on a closing basis, so next week I think it's pretty obvious to see that if we break back below the low this week, which was about 114.75, then we possibly turn sideways still. Or lower rather, on the daily time frame, we do have an important level in this area, and that is this prior resistance over here. We've also got the 50-day moving average. That's the green moving average in this area. So it doesn't seem imminent that we're going to experience a larger breakdown, but if it gets below that 114.75 and stays below it, then you have to be a lot more defensive in your outlook towards the market. Semiconductors broke their first level of support in a while. while here, and did so with a declining 5-day moving average. So this group is clearly undergoing some profit taking. When we look at the daily chart, we've still got a primary uptrend, and this might be similar. This might be the beginning of a similar pullback to what we saw in July. Now we've got a nice uptrend here, a pullback, an uptrend, and we're pulling back. So for now, all we can say is it's looking like a pullback and an uptrend. It's time to sidestep it, unless you're an aggressive short trader, which is the right thing to do for an intermediate term standpoint would be to have a short bias. I think next week, if we want to see that these semiconductors are bullish once again, I think that basically between about 51.85 to 52 is our band of potential resistance that we want to see cleared. So as long as we're below that on the intermediate term, we're guilty till proven innocent with this the lower highs and lower lows. And the daily time frame, we're still innocent till proven guilty. So we have mixed messages, and that means the market is telling us it's time to go slow. Slow things down a little bit, wait for them to set up and reveal the lower risk, high probability opportunities. The financials are holding up much better than the broader market indices, and that key level still remains 23.15 to 23.25. That is our big important level that we want to see continue to hold. As long as we hold above that, we give the benefit of the doubt to the buyers, and we look at this as a consolidation, a sideways consolidation in a larger term uptrend, with the band of resistance now 23.50 to 23.60 and support 23.25 to 23.15, as we just had previously mentioned. Now you could, if you wanted to, look at this and say, hey, isn't that a head and shoulders pattern? And maybe it is, but maybe it just keeps turning sideways, churning back and forth. It doesn't really matter if it's a head and shoulders pattern unless it actually breaks this support anyways. 23.15 to 23.25 is that key level. That's what you need to stay focused on objectively. Someone asked me in the webinar that I held Thursday night, which by the way, we did have some tech problems and it didn't get recorded properly, so I apologize for that, but I'll be doing another one again here in the next few weeks. So make sure that you're on that email list to get those, and that's where you sign up at alphatrends.net. I know some of you guys view these videos just on YouTube, and you're not going to see the invites on YouTube, so make sure you sign up for that email. Anyways, going back to this, it's only actionable if it breaks down below that level, and even then I wouldn't expect a huge decline, maybe a pullback down towards 23 or so. This week we saw, of course, gold continues lower, and as I've been saying, if they don't scare you out, they'll wear you out, and this market looks like it's probably headed for a retest of the lows down near about 114. Gold continues to be a waste of time. It got sold off pretty hard this week. There's probably going to be a bounce in it, but your guess is as good as mine. I don't want to look for that bottom. I'd rather just avoid gold altogether. The dollar has been strong recently. My friend JC over All Star Charts, he was bullish on this thing before, as it was just starting to show the first signs of bullishness, and a lot of people were against him on that call. So nice job, JC. But we saw gold up, the dollar down, and we saw bonds get hit real hard too. Let's take a look at that again. The 20-year average bond was down about 2% this week and 4.7% for the month. So this market is still in a longer term uptrend. We've still got a rising 50, 100, 150 and 200-day moving average, but we came into this prior band of support over here, and now it seems as though it's acting as resistance. And with this break of the trend line and the fact that we have the lower highs and lower lows, and we're below a declining 5-day moving average, we mentioned this last week that we were below the declining 5-day moving average, that it seemed as though maybe it was due to find some support in this area. However, we don't want to be a buyer, not while it's below a declining 5-day moving average. Below a declining 5-day moving average is guilty till proven innocent, and we're seeing some profit taking in the bonds. Where it ends up is anyone's guess. We have another potential for support in this area. Basically, I'd say 112.60 up to 113. That seems like a likely area of support, but But again, it's difficult to pick bottoms, so just ride the trends, avoid them when they're pulling back in the primary uptrend, and do what makes sense for you on whatever your primary trend is, whatever your primary trend time frame that is. As I mentioned, the IYR got hit real hard today. This is the real estate, commercial real estate index, and we've got the potential for a bigger level of support down here at about 70.5 to $70.75 really. So we've had a tough 5 days in there, and this is why risk management is job number one. You can see you get cautious as it's below the 5-day moving average, but you don't get short until it makes a lower low below a declining 5-day moving average. This market recovered, and it's possible the S&P will recover in this same scenario next week, or the NASDAQ will. But if it starts to make that pattern of lower highs and lower lows below a declining 5-day moving average, expect that the intermediate term will give you trouble here. So we've got the potential for some support, but there's obviously zero signs that it's actually finding support in this area right now. So be careful with those. Apple this week did recover some of its losses, obviously, and close back up to those all-time highs. We had, of course, the product announcements this week, and that began right here. So the volume weighted average price since that event is about $100.15. We could look approximately at the 4-day volume weighted average price and see that this is the day that the event occurred. We saw that initial rally, and then it got hit hard. It rallied back up, and then it held the VWAP since the event right here. So I think that's going to be important going forward as a measurement of who's in control. So if it pulls back down towards the volume weighted average price on next Monday will be the 5-day volume weighted average price, then we would be looking for the potential of support at that area, and then the possibility of purchasing on the way back up. Shares of Twitter this week did slow down a little bit, and this market, Twitter seems as though it's getting a little bit tired. As we know, we were talking about it very bullishly a couple weeks ago as it got back above that volume weighted average price since the event right here at 45.10. If anyone's holding this and has not taken some profit, I think you should, and set the stop at the level that's comfortable for you, perhaps all the way down here. That's a pretty big stop in my opinion, but again, I like to get people into the trade and help them along the way, but I don't tell anyone what to do, and that's the way it is. Also, we spoke about the biotechs. The biotechs are still in a healthy uptrend on the daily time frame and finding support at this prior level of resistance. So we've got an important band of support at 265 to 267 right now, but on the 30-minute time frame, you can see we're starting to see this choppy action, kind of indecisive. This shouldn't have been bought into because the 5-day moving average was still declining. The market tried to recover at the end of the day yesterday, and in my mind, it's going to need to get back above 275 for the buyers to be back in control. That's above this high right here. We also saw that the Zeltic continued to really move higher very nicely. I'd mentioned it on Yahoo Finance right here. Again, trade the stock according to your personal comfort levels, but it's been a great move. Make sure you lock some in on the way, and make sure you have a method for getting out. That is your stop level, which should be continuing to rise up underneath the success of higher highs and higher lows. I also wanted to talk about Crocs once again, because this is one I spoke about, and I was talking about the fact that we wanted to see this stock recover and move beyond the 1610, 1620 before we could get involved in this with confidence. That this weekly chart was looking decent, but we didn't want to buy it as it's pulling back, but instead to watch the stock. There's no harm watching a stock and waiting for the right opportunity. There's no reason to be involved in Crocs, and by avoiding it and having it just as a trading candidate, that right there gave us the opportunity to keep our cash. You don't have to be involved in an idea just because it looks good. You want to get involved at the right time, at the right price, and that's when prices are moving higher. It's not the right time when prices are moving lower.